It's not that the Fed is going to raise rates too much. It's that they're not going to raise them enough. It's that they're going to pivot too quickly. It's not that the Fed is going to mistakenly believe that the economy is strong and then to overestimate how high inflation will be. It's the weak economy that's going to cause inflation to be higher, because as the economy weakens, production will decline, but money printing will.
Peter Schiff knew that most investors would have trusted the latest data released by the Fed. This data suggests that the market is doing great, and soon, we will be seeing the U.S. economy making a big breakthrough. However, Peter Schiff, CEO and founder of Euro-Pacific Capital, author, chief economist and stockbroker, said that the Fed's data is more like Sam Bankman-Fried's reputation. Everyone trusted Sam Bankman-Fried and his fraud FTX by seeing the superficial profits. Nobody tried to peep into the sheets to see the number of staggering debts FTX. The same is the case with the U.S. economy and the Fed reports. Even if they are showing a growing market, the reality is shocking. But what is it? Well, listen to what more Peter Schiff has to say about that. Stay tuned until the end of the video to know Peter Schiff's insights on the Fed's report, the future market, and the reality of inflation. Let's get started. We must give you the context first. Peter Schiff is concerned about the tempered and fabricated data that the Fed has released. Investors are trusting the data and changing their stance about the market. However, in reality, the market is as down as it was before. But the investors are reinvesting and expecting growth that will never happen. The Fed released the latest figures that show that the market is growing and surpassing the predicted points. However, Peter Schiff said that the Fed is just quoting the short-term point growths, which can never tell about the overall market. However, if these misguided figures are allowed to stay, ultimately, the investors will invest more. But in reality, the market would be going down further. In the end, it would be investors who would lose their money. Therefore, Peter Schiff said that instead of trusting the wrong figures, the Fed released them. Here's a little reminder to like the video if you were loving it. And if you don't want to miss videos about the evolving economics and the financial order, subscribe to our channel. Let's continue now. And that's where he uncovers the reality of the market.
Don't accept the numbers at face value. Dig a little deeper and look at what's actually happening. Because if you do that with the jobs numbers, as I've been doing on this podcast, the jobs market isn't strong. The jobs market is weak. And the risk that everybody is worrying about is once again the wrong risk. It's not that the Fed is going to raise rates too much. It's that they're not going to raise them enough. It's that they're going to pivot too quickly. It's not that the Fed is going to mistakenly believe that the economy is strong and then to overestimate how high inflation will be. It's the weak economy that's going to cause inflation to be higher, because as the economy weakens, production will decline, but money printing will expand. In fact, at some point, the Fed will pivot in response to a much weaker economy than it expected, and that's when the dollar is really going to tank, and that's when consumer prices are really going to take off. The inflation that we're experiencing now is going to kick into a much higher gear during the next economic downturn. That's what nobody understands. Everybody just assumes that when the economy weakens, so too will inflation. No, the weakening economy is going to strengthen inflation, because inflation is the expansion of the money supply. And the weaker the economy gets, the more the Fed is going to expand the money supply to try to stimulate it. And as the return of quantitative easing causes a mass exodus out of the U.S. dollar from foreign central banks and private holders, then the falling dollar is going to push consumer prices up dramatically, also increasing the size of our trade deficits and our current account deficits, creating a self-perpetuating spiral of inflation and economic.
Peter Schiff said that the job market is actually in decline, opposite to what the Fed has been showing. Also, the investors are scared of the wrong risks. He said they shouldn't worry because the interest rates would be increased. Rather, they should worry that the interest rates would not be raised enough. Peter Schiff has been a strong proponent of rising interest rates for goods. However, the Fed tries to show people that the economy is in good shape, which is why the interest rates will increase less violently. Peter Schiff said that investors should fear the low rate of increasing interest rates because, in the end, it would be the investors who would pay for the Fed's mistakes. He said that the mistake is not that the Fed is mistaken about the strong economy, and that's why we would see harsh inflation. But the reality is that the economy is weak, and that's why we will see hyperinflation in its worst form. The Fed wants investors to know that the economy is strong, but then it would give the impression that it was mistaken, and that's why there is inflation. However, here's what the Fed doesn't want you to know. The economy is weak, and when the economy is weak, production always declines. However, the Fed has already printed more money. Therefore, a massive amount of cash would be available for the scarce products, which would skyrocket the prices. That's why we will witness the worst form of inflation that ever existed. Even the Fed would print more money during the most fragile economy. It would further increase consumer prices, and again we will see inflation. Peter said that everyone is wrong about future inflation. Everyone expects inflation to come down as the economy declines. However, in reality, since we have a tremendous supply of money, inflation will increase as the economy slows down. The weaker the economy, the stronger will be the inflation this time. Until now, the USD has been reaping benefits. But when inflation increases, it means a decline in the USD value. Therefore, the US trade deficit would increase further. When countries know that the USD value is declining, they will eliminate the USD in their foreign reserves. This in turn will decline the USD further. Therefore, the US economy will be in a perpetual downfall where the USD value will keep decreasing while the size of the economy will keep shrinking. Now let's know the stock market's reality, which can shock some investors. The Fed said that the market is improving, right? Well, Peter Schiff debunked that and talked about the weak nature of the stock market, which is in continuous decline. Listen to what he said.
Weakness. But getting back to what happened in the stock market these past couple of days as a result of this stronger than expected data that came out on Monday, the Dow is now down about 830 points in 2 days. That's a 2.4% drop so far this week. Now, for the month of December, which includes another 2 days, it's down 2.9%. S&P 500 is faring even worse. It's down 3.2% in the last 2 days, and it's now down 3.4% for the 4 days of December. This is the fourth consecutive day that the S&P is down. So it's been down every trading day of the month so far. The Nasdaq doing even worse, down 3.7% this week, 4% this month. And if you look at the more speculative names in the Nasdaq, the Cathie Wood ARK Innovation Fund, that's down 9.3% this week alone. Its biggest holding, Tesla, down 7.7% on the week. Now, the gold stocks are also down. Gold stocks are down 3.6% so far this week. But for the 4 days of the month, they're barely down. The decline is less than 1% on the GDX. Gold itself is down 1.4% in the past couple of days. Silver down about 4%. But on the month, silver is basically flat. So most of its gains it has retained. In fact, the stock market has given up all of the gains since Powell's speech last week, where the markets rose in the face of his hawkish comments. But the gold stocks have not. In fact, the gold stocks are still up about 6% from where they were before that speech was given. So despite the big drop over the last 2 days, we still see a lot of strength in the gold stocks. And I expect that to continue. Remember, if we get a year-end rally in gold stocks, the big difference between a gold stock rally and a regular stock rally is that the gold stock rally is for real. This is a bull market. This is not a head fake. This is not a sucker rally. This is not short covering. This is new longs coming into the market. This, I believe, is a massive bull market that is just in its infancy. And at the same time, gold is in a new bull market. The US dollar is in a new bear market. In fact, the dollar made new lows and gold made new highs on Sunday night before the U.S. market opened up, we had gold up about $10, $11. It was close to 1,810, I believe, on Sunday night before the reversal. As I'm recording this podcast Tuesday evening, gold's about 1771, back below 1,800, but it's held on to most of its gains. Silver's still trading above 22. It's 22.17. The dollar index is now back above the 105 handle, but on Sunday night, it was very close to breaking below 104. I think we got down to about 104.2 before we had the rally on Monday and then some follow through on Tuesday. But the dollar decline to me still looks like it had legs. I don't think we're just going to make one move below 105. I think the next time we go below 105, we may stay below 105. And I think the same thing could be said about gold. Once it gets back above 1,800, 1,800 may be the new floor rather than the ceiling. And by the way, there's a lot of people out there that are talking about Bitcoin building a floor at 1,700 because Bitcoin has been trading at around 1,700. And even though the NASDAQ has dropped quite a bit over the last couple of days, Bitcoin has kind of traded sideways, and that's caused a lot of people to claim, aha, we found support, this is a bottom. Remember, this is the way Bitcoin has been falling pretty much the entirety of the bear market ever since it was just under 70,000. Bitcoin makes a move down, and then it consolidates those losses before it takes another move down. But every time it consolidates its losses, people are saying it's forming a bottom. It's not. It's building a trap door, and then the market falls through it. This is a staircase down. And every time Bitcoin stops falling, it's simply resting on a landing, getting ready for the next leg lower, which is what's about to happen. It's interesting that we haven't really had a major one-day meltdown in Bitcoin. We've had a lot of those big crashes in the past. Most of those big crashes happened on the way up. And what those declines did is they shook people out, but they gave people an opportunity to buy for the next move to new highs. But we haven't had any of those big scary declines during this bear market. Why? Because bear markets don't want to shake anybody out. They want to keep everybody in. They want to give people a lot of false hope that the bear market is over. Remember, bear markets slide a slope of hope. And if there were more spectacular one-day crashes, well, the hope might be dashed. But right now, the Bitcoin hodlers are kind of like the frog being boiled slowly in a pot of oil. He doesn't realize he's being boiled, and so he doesn't jump out. That's what people should be doing. In fact, even Jim Cramer on his most recent television show said that everybody in crypto should get out. He had been encouraging people at one point to get into crypto. Pretty much everybody on CNBC did that. But at least now Cramer has got the good sense to tell people to get out. In fact, Jamie Dimon was on CNBC today talking about Bitcoin, criticizing CNBC for covering it so much, just like I've been doing, although not quite as sharp a criticism as mine. He referred to Bitcoin as a sideshow, and he compared Bitcoin to pet rocks, which, if anything, sells pet rocks short, because pet rocks actually have some utility. You could take a pet rock and you could use it as a paperweight. If it's heavy, I suppose, a large enough rock, you could use it as a doorstop. You could use it as ammo for your slingshot. You could take a pet rock and you could put it on the bottom of.
Showing exactly the opposite trend, the Dow Jones is down by 830 points in only 2 days, hinting toward a 2.4% price drop within a week, while the best-performing stock index S&P 500 is down by 3.2% in the 2 days. And what about NASDAQ? Well, it's even worse, with a 3.7% decline in the last 7 days. In 1 month, it has decreased its price by 4%, which is just unprecedented. And that's not the end. More figures show how big lies the Fed said to the investors. Cathie Wood's ARK Innovation is down by a staggering 9.3% in the last 7 days, while Tesla is down 7.7% within a single week. Even when all stocks have declined, gold's price appreciates. Peter Schiff said that recently, the USD price touched the lowest while the gold price touched the highest points. In other words, we will see a bullish gold market unfolding while the USD market will go to the bearish side of the spectrum. Peter said that gold is creating a new floor for itself at $1,800. Once it crosses the $1,800 ceiling, gold will have $1,800 as the new floor, and its price will move upward. But the opposite is the case with the USD and Bitcoin. Their floor price becomes the ceiling price the next day, and this continues to get repeated. So if investors buy stocks, USD or Bitcoin, they may trap themselves in a perpetual decline. Peter said that investors should consider gold instead of being a part of the declining bandwagon of assets because its market is bullish now. But why assets like gold? Well, during the uncertain times when the economy and future are so blurry, you should invest in something foolproof and recession-proof. If the stock market declines, a recession comes in, or worse, inflation ushers in, or the entire financial market is destroyed, gold will still hold value. You won't be able to have your stocks back or get bitcoins in your crypto wallet, but you will certainly be able to touch the gold you would have with you. That's why Peter said about investing in gold. Do you agree with Peter's SCHIFF that the worst inflation is coming your way? Do you think the stock market, crypto market, and the USD will be in decline from now? Would you want to invest your money in gold, as Peter called it, a good asset during these times? Comment your opinions in the comment section right below. Do you want to watch more videos like this one? If yes, please like and share the video and subscribe to our channel for more videos on the latest economics and financial news. Until the next video, stay tuned.